Welcome back, everybody. Doug Burson, CPA, and today we're going to talk about the electric vehicle credit. And it's important because with the new administration, things are changing. So I'm going to talk about 1, will the credit go away? 2, what happens if you've already bought the car and the credit goes away? 3, who qualifies for the credit? And this is super important because some people are going to be surprised. Number 4, what happens if you don't qualify? That's going to be a big one that people aren't thinking about. And lastly, how could you take advantage of, this one's the secret one, how could you take advantage of the credit if you don't qualify? So if that sounds good, go ahead and subscribe. Let's go ahead and get started. Okay, for starters, will the credit go away? I'm going to be honest here. I don't know. But it was a part of the Inflation Reduction Act, which means it's going to be harder for it to go away. However, does President Trump have the sway in Congress to get that done? It's quite possible. So I think there's a real risk that this is going to go away. So what does that mean for you if you're looking at an electric car? Well, it probably means you want to take this serious and get motivated about buying one. And unfortunately, as more people start to think about this, demand's going to go up. And so are prices probably. So if this is you, you probably want to watch this video, get all the information, and then make an educated decision. You also probably want to talk to your CPA and make sure that you qualify. Now, with that being said, what happens if you've already bought a car that qualifies for the credit and they do away with it? 1, I don't want you to worry as long as you're watching this before any changes have happened. If nothing has happened to change the law yet as of the time you watch this video, you can rest assured that in the U.S. anyway, we normally do not change laws retroactive that hurt us. There are times when they'll go retroactive that benefit the taxpayer, but I've never seen where they go ahead and change a law, at least for most of us. I'm sure there are exceptions, but for the average person, they're not going to change a law that says, hey, you bought that while credit still existed, and now you don't get it. That's not how tax law usually works. You're grandfathered in. So if you got one, don't worry about that part of it. However, if you haven't, let's go ahead and stay tuned. And even if you had, stay tuned because there's important things here that I think a lot of people don't understand. All right, so moving right along to the third point that I started at the beginning, who qualifies for the credit? And this is super, super important because a lot of people are going to go to the dealership and be told they qualify and they don't. And how do I say that? Because I had a guy last year who bought one and his income was too high. He thought he was getting the $7,500 credit and he didn't. And you don't want to be that guy. So let's go through that real quick. Okay, so if you're going to qualify for the credit, and I'm going to put this up on the screen so you can look at this is a very handy handout from the IRS. We're going to look at 2 of those. Do you qualify for a new clean vehicle tax credit? First thing is an AGI limit. So that's your adjusted gross income. And for those of you who make $300,000 or less and who are married, filing joint, or a surviving spouse, and what does a surviving spouse means? Well, unfortunately, that means your spouse died during this tax year. But for IRS purposes, you're still considered married for this year. And if your income is less than $300,000, you qualify. If you're a head of household, that limit is $225,000. I get this all the time. Well, I am the head of household. Well, maybe you are, maybe you aren't. The key to being a head of household generally means you have to have a dependent that lives in your home. Normally that's going to be a child, but it could potentially be a parent too that you're taking care of. But head of household means you have to have a dependent. If you live in your house by yourself and you have no dependents that you can claim as a general rule, then you're not head of household and you're going to have to drop down to the next one. And that one is $150,000 for single. So what does that mean? Well, that means if you made $151,000, you don't qualify to get the credit unless there's some kind of an adjustment on your tax return that we can take for maybe self-employed health insurance or something like that. But if you're at that point, you want to make sure you talk to your tax guy because otherwise you're going to go in to get your taxes done and find out you don't qualify for that credit and you're going to be really bummed out thinking you were going to get a big check. So those are the limits there. What else? Well, it has to be an electric vehicle, a plug-in hybrid, or a fuel cell. And the numbers are, it has to be below $80,000. Rely on your dealer. They have the MSRP. They should give you this number. I'm not going to try to nail that down. But it's $80,000 if it's an SUV or $55,000 if it's a car. So that means your Model S is out. Your Model X, it probably could qualify as long as it doesn't go above $80,000 because they're classified as an SUV. But the Model S doesn't count at all. And you also have to be careful on the Model 3s, and I'm only talking about Tesla because that's what I'm the most familiar with because I have a Model 3, is if you start getting up into the higher packages, especially the performance models, you may go above the $55,000 and not qualify. So be careful with that. That $55,000 is super, super important. But Tesla's usually really good about letting you know if it qualifies, and most of the other dealers are too. Now, as far as whether it qualifies for the full 7,500, I'm not going to get into the battery requirements. Your manufacturer that you're buying from will give that to you, and you can rely on that. So I'm not going to worry about that. But you can go to the IRS's website and look at a list of all the cars that do qualify. So that's that. But there's also another one. It's called the used clean vehicle tax credit. This one's harder to qualify because the used electric market, the prices are pretty high. And so most of them won't qualify, but it's a different AGI limit too. And here's also a nice little sheet here from the IRS's website to cover that. But if you are married, filing joint, or surviving spouse, we already covered that. For this credit, it's $150,000 or less, or $112 for head of household, or $75 for single. So a lot lower income limits. So make sure you're clear on that if you're looking at buying a used one, that you don't get confused on the AGI limits and end up thinking you get a $4,000 credit, and you don't. In order to qualify, the car has to be less than $25,000, and it has to be sold by a licensed dealer. This is one that can mess you up too, where you think you went and bought it from somebody on Craigslist, but they're not a licensed dealer. That's going to cause you problems for this credit. So be very, very careful with that. And this credit is a $4,000 credit, not a $7,500, but it's $4,000, but it's $4,000 or 30%, right? Whichever is lower. So if the car is only $20,000, you take 30% of that, 3 times 26, so that's 6. That one would be okay. But you can see where that goes. It's a 30% credit of the purchase price. So that's how that one works. Okay, so now to the next point was what happens if you don't qualify? And this is the one that is scaring me the most about this, because starting last year, the dealers were allowed to get that credit on your behalf. You could go ahead and sign over the credit to the dealer, and what they would do is they would reduce the purchase price, and you think everything is wonderful, you're not worried about it, and you're going to file your tax return in 24 or 25, and you didn't meet those limits we just talked about a minute ago, right? So maybe you made $302,000 because you got a bonus that you weren't anticipating. Well, now we have a clawback, and you're going to have to actually pay the $7,500 back. Or remember, we have the $150,000 for the used car. If you let the dealer take that credit and reduce the purchase price of the car, and you go to file your tax return, you're going to have to pay that back. They're calling it a clawback provision. And this one worries me the most because people are just taking for granted that are going to qualify for it. Another thing that really worries me about this is you thought you were going to qualify for a $7,500 credit, but this is not a refundable credit. This credit can only offset tax. So if you only made $30,000 and you're married, so you have zero taxable income, one, you shouldn't have been buying that car. That's a whole other issue. But two, I mean, maybe you should have. Maybe you got a lot of money in the bank, so I take that back. But two, you're not going to qualify for the credit because you don't have any taxable income that's going to create tax. The credit can only offset tax. So that's why I'm saying it's so important if you're looking at doing one of these, look at last year's return, think about what the next year's income is going to be, and make sure you have enough tax to actually use this credit. That would be an awful feeling to come in and file your tax return and find out you owe it all back. because either A, you made too much money, or B, you thought you were going to get it, but you don't have any tax to get it. So those are two things that I think people are going to be surprised by. So I told you there was a super secret. Now I'm going to tell you about that. What happens if you don't qualify for the credit and you haven't bought the car yet? Is there a way for you to take advantage of this? And the answer is yes. Let's assume you make too much money, or let's assume that maybe you just don't have tax because of how your income comes in. Maybe you got a bunch of rentals that are offset by depreciation and you don't actually have any taxable income or not enough to generate the credit. Or maybe you have a bunch of children and your children's child tax credit's offset. There's a lot of different ways this could happen, but you just don't qualify. Well, you could potentially take advantage of it through a lease. What's happening is the lease companies are taking the $7,500 credit, and a lot of the companies are letting you directly offset the price of the car before calculating your lease. That is okay. We can have a whole nother discussion on whether you should lease or buy, but if the math works for you on this deal, that's okay, because guess what? You're not the one who took the $7,500 credit. The lease company did. It's their car. You're just leasing it, and this could be the way for those of you who don't qualify. Maybe you have a high income. Maybe you make $400,000 a year. You really want to take advantage of this, but you can't get it because you make too much. Leasing may be the way to go. Normally, I don't like leases, but if you put the pen to it and it makes sense, this might work and you could still qualify for it. So there you go. That's the credits. We're going to have to wait and see what happens. Once again, go ahead and subscribe. I'm going to keep you up to date on all this as we go along. And if they do repeal this, remember that was done through the Inflation Reduction Act. I'll make sure to let you know. But if you've already bought one, don't worry about it, unless they've already repealed it and you're watching this after that. That's a whole other deal. But when that happens, if that happens, I'll make a video talking about that too. So with that, you have a wonderful day, and we'll talk to you soon.